Good morning, everybody. I'm
Yeah,
Nicola Barrett, Chief Corporate Learning Officer at Emory Executive Education at Goizueta Business School, and it's great to see you all come in from the waiting room on this, the 1st of May. And as Tom and I were saying a little earlier, we are in our 6th year of running Business Over Breakfast, and Tom was the instigator. It was his idea right at the beginning, back in March 2020. So it feels like we're at a very similar type of place that we were when you first came up with this idea, Tom, around uncertainty and not sure what's going on. As somebody talked about, this is having a weather forecast that says it's sunny with a chance of storms, and that's not that helpful. And I think that's what we're really thinking about and grappling with when we think about the global economy right now. Lots of mixed signals, lots of uncertainty in terms of the outlook, a lot of speculation. So today, everyone, we're going to dive into this complex landscape with our session on recession or resilience, decoding the US economy's mixed signals. Tom Smith is the professor in practice of finance and also the academic director of Goizueta's Master of Finance program. He's going to be our guide through this discussion and going to help us break through all the noise, explore what the data is really telling us, and consider what may lie ahead for us, both as business professionals, but also for our organizations. Tom holds a PhD in economics from the University of Illinois at Chicago. He's an expert in the areas of labor economics, pricing, sports economics, and finance, as well as the economics of the entertainment industry, healthcare, and film finance. You may have heard him or seen him in the media, as he regularly appears as an expert on national television and on radio. He's frequently quoted. I often wake up, Tom, and you're on the radio. Like, yeah, I know him. He also teaches in several of Goizueta's degree programs, as well as our own finance and accounting for non-financial managers. And the next one is scheduled for the fall of 2025. And while we're on the topic of uncertainty and our short courses, we also have our upcoming 2-day course on disrupting your business strategy. That's happening mid-May. That's May 13th and 14th. And that's, I think, a timely opportunity for people to do a deep dive into what makes your business relevant and viable for the future, and how to approach this from a more creative perspective than the old strategy processes of the 1980s. So check that out. And I know one of the team is going to put something in the chat around that. Many of you will have seen Tom on previous Business Over Breakfast. And he, as usual, will share some initial thoughts on what's going on, what he sees in the data, and then open up for Q&A. So please put your questions into the Q&A box, and I will do my best to feed them all to Tom. Over to you, Mr. Smith.
Thank you, Nicola. I always enjoy meeting up with your team. These are great individuals. And to those of you who are thinking about doing even open enrollment, or if your company wants to do something a little more specialized, this group can put together an amazing program and find you, some of the best professors in the country to lead you in a discussion or exercises to help business become more profitable, or for you to be able to communicate with your customers better. So this team is amazing. I walk through their space a couple times a week to get to a class that I teach at 8:30 in the morning. I'm like walking through, I'm like, hey guys, walking back. I'm like, can I have a snack? So they're amazing people. So I encourage you guys all to reach out. All right. I think I know why you're all here. We're going to talk about the economy. The economy is, it's a little challenging here. I'm going to pull up a little presentation I have. I'm not big on PowerPoints. I did these little like PDF slides here. And I should have changed this. I should have changed this date. But other than this date here, everything else is up to date. So here's how I'm thinking about this. So everybody's head is spinning with respect to the economy. The Trump administration put these tariffs in place, announced it on April 2nd that there was, like this day of reckoning or what have you, the, International Freedom Day or whatever he called it, and said like, we're going to have all these huge tariffs. And then he put a pause on it, but he didn't put a pause on every single tariff. There's still 10% tariffs on Mexico and Canada, and there's still some very, very high tariffs on China. I suspect there's carryover quotas from South Korea with respect to steel. So there are still tariffs in place, even though the 90-day pause is on all of these reciprocal tariffs, is what the administration called it. There's still a bunch of tariffs in place. So here's some just basic statistics I'm going to walk through, and then I'm going to open up for some Q&A. So unemployment is still hovering at about 4.2%, up from 4.1% last month. It's bouncing around between 4.1 and 4.3. That is actually a positive. I like the fact that the unemployment is hovering and staying relatively low and staying consistently low. We're breaking stock market records, but not the good kind. So we were in bear market territory, which is a 20% drop from the market highs. And we've had some crazy gains and crazy lows, and some stocks that have just really like at lots and lots and lots of movement. I think people are really anxious about profit margins, about earnings calls, about what the market means. So there's a lot of anxiety there. Inflation is being stubborn. So inflation is below 3%, but the Fed cannot quite get it to 2%, which is part of their target via the Taylor rule that the Fed follows. The Fed is very persistent on trying to drive inflation down to 2%, which I think is motivating some of their policy right now. Savings are down, loan delinquencies are up. That's a signal that I'm looking at, and that could be very, very challenging. Not a good signal at all. Consumer sentiment is falling very fast. People are unhappy, and this was released yesterday. The most recent quarter-over-quarter change in real GDP is negative, although it's negative. I mean, it's just a calculation. Real GDP is consumer plus investment spending plus government spending plus net exports minus imports. And imports last month went way up to try to anticipate these tariffs. So there's policies to get all the imports in before the tariffs are hitting. So imports went way up. And because it's a negative sign, I mean, technically it drove our GDP into the negative territory. So you could say like, so I mean, that doesn't really mean anything. It doesn't mean anything if you're not thinking about how this signal could send reverberations into the economy. So let me go over a couple of these charts so you have an understanding about where I'm looking at these different numbers from and how I evaluate them. So there's 7 signals that I'm looking at right now that suggest that the economy is slipping or going to slip into an economic recession. 2 signals that the economy is doing fine. I don't know if 7 is greater than 2 here. I mean, this is a very simple math, but math is always more complex than just a couple of numbers here. All right, here's what I just mentioned about the GDP. Quarter over quarter change in real GDP is negative. So you can see this little bar all the way on the right-hand side here has dipped below this 0 axis. So this was negative. Now you'll notice here, this big negative bar in March of 2020, that was the COVID recession, right? We had a couple quarters here in 2022, one negative, one slightly positive. This was not an economic recession, technically. I think this is actually consistent with the period. This predated something that was called the Great Resignation, where people started quiet quitting. I think this is one of the soft landings that Powell has talked about. I think the economy may have actually slipped into an economic recession, but it was not technically a recession. And so this is not a good sign. I do not like the fact that GDP growth is negative. This could cause people to change their behavior. Okay, here's the market. I'm sure a lot of people are paying attention to the market. When I say the market, this is just the S&P 500 index. I grabbed this from TradingView. There's so many other places that you can track the market. So the market is still down from its highs. The market is still down for the year, I think, and I believe it's down since Trump was elected, certainly down from when he was inaugurated. All of this is this craziness because the market is jumping, 100 points, which is nothing, then 1,000 points, which actually is something, and then going back up 500 points, and then dropping another 400 points, and then going up 300 points and dropping 200 points. This volatility is very unsettling, very difficult to find yourself in a place where you can make good policy, knowing that the market is so volatile. Now, of course, the market, that is the stock market, is not the economy, but a lot of people use the stock market as a signal of economic health, and that's what I'm doing here as well. It certainly is a signal that many consumers, investors, businesses did not like the tariff policies. The Fed is being very stubborn. There's been a lot of chatter about the Fed lowering interest rates or lowering interest rate targets. The Fed is not inclined to do that as long as inflation is being stubborn. Okay, right? So here, inflation is hanging tough, and we're still above this 2% level. The Fed sets this 2% target because there's something called the Taylor Rule and the modified Taylor Rule, which doesn't dictate Federal Reserve monetary policy, but it does influence the policymakers quite a bit. So the Fed will set target interest rates, and they will modify them if inflation is above this 2%. So they'll target higher interest rates, pull money out of the economy to try to push prices down. As long as this is above 2%, the Fed is not likely to decrease rates. Why is this Fed being stubborn and inflation hanging tough a signal the economy might slip into a recession? Because the Fed is not likely to come to the rescue. And it does often, right? You can see here in March of 2020, the Fed dropped, their effective federal funds target rate from 1.75 something all the way down to zero in essentially over a couple days. And they did this because as the economy was slipping into an economic recession because of COVID, you pump more liquidity into the market and drop interest rates, then you can encourage investment spending, people going out and borrowing money for cars, homes, businesses, and what have you. And that can get the economy back rolling. The president of the United States has suggested that too late Powell is not lowering rates fast enough. I mean, he's not lowering rates at all. The idea here would be, well, if the economy is suffering, then you should lower interest rates to prevent an economic recession or to try to build some economic traction. And the Fed is saying, yeah, we don't think so. We're going to hold rates pretty constant. So this, if I care more about inflation than I do about real GDP, then I'm happy that the Fed is very, very stubborn. If I care more about real GDP than I do about inflation, then I want the Fed to be less stubborn. I think right now the Fed cares more about inflation than they do about real GDP. So a stubborn Fed means that we could slip into an economic recession without the Fed's, like sending out a rescue line. Capacity utilization in automobiles is down. I think about the Midwest because I was born and raised in Chicago and raised, outside of Chicago. I think about the Midwest as being a really important barometer for our economy at large. and looking at farmers, but also, huge auto sector over there in Detroit and around there. And of course, we've got automobiles that are being built in West Point, Georgia, and Chattanooga, and Camrys are made in Kentucky, or the Tundra is being made in Tennessee or whatever. I mean, it's becoming much more broad industry in terms of geographical location, but I still really think it's an important industry. I mean, it employs a lot of people, and it's a good barometer. Our capacity utilization in automobiles is going down. That is, we're producing fewer cars relative to the number of cars that we could be making. This downward trend here, this is very troubling. Because I think that what's going to happen is we're going to see some additional firings here. We already did with Stellantis. I think they laid off maybe 900 people, not very many, but I mean, this is troubling. I do not like this downward push, right? I mean, we can see here this downward push here in 2004, 2006, whatever else. This sort of predated the Great Recession. I do not like this signal. This signal, and you'll notice, like you say, oh, but what here in 2014 we started going down. Nobody could predict this recession. No, but I mean, this is employing a lot of people. This is a lot of wages. This is a lot of capital expenditure. This is a big part of our GDP. This is not a good signal. Consumer sentiment, as I mentioned, is down. This just, I mean, it bumped up a little bit after Trump was elected last November, but since then it has decreased. People are not happy. Like, people are really not happy, and so we've had this is continuing to fall. And I would, pay attention to these numbers over the next couple of weeks, maybe next month and a half, 2 months, to see like how far this falls. And there's a good reason why I fear this, because 70% of GDP is made up of consumer spending. If consumers are feeling unsure about where the economy is heading, then they're likely to hold on to their dollars. If they hold on to their dollars and there's less dollars actually churning through the economy, then real GDP could fall. And then that will cascade into companies firing workers or not making the hires that they anticipated, laying off workers, spending less on recapitalizing their plant. And then all of a sudden you are in a full-blown economic recession. So we don't want consumers to be unhappy. If consumers are unhappy, they don't spend money. If they do not spend money, the economy will fall into an economic recession. Okay. Earnings, this red line here is a counterfactual. Basically just took a regression of where earnings could be if we didn't have this COVID spike and drop. And this is one of the reasons why people are so unhappy about the overall state of the economy. All right. And that is, their real earnings are now actually starting to go up, but they're not nearly as high as they would have been if the economy hadn't had this shock. And some economists would argue, people really don't care about real incomes. They only care about if they're making more than their neighbor. They only care about if, their account is full and they can buy the things that they want to buy. I think economists who say that are often ignoring, some of the really powerful expansions that we've had, like in the 2000s, right? So 1996 through 2000, really powerful expansion we had in the United States, and people were seeing wealth and they were spending based on wealth, and that wealth was creating wealth. Of course, it resulted in a stock market bubble. But there was real wealth created even after the stock market burst and came back. Companies were strong. The companies that came out of that were actually significantly stronger. So I think people do pay attention to how much they could be earning or how much they would have earned if the economy hadn't gone sideways. If it hadn't gone like this, I would be at this position. At some point, that really does wear on people. And then also here, these delinquency rates, this troubles me quite a bit. Delinquency rates on consumer loans are actually starting to go up. And that would be this would be really bad for banks, financial intermediaries, other kinds of loan companies especially if people started defaulting on a lot of car loans. They're already defaulting on other loans, not as many mortgage loans as we saw in 2008, but they're defaulting. This is bad. People start defaulting, then all of these, private equity companies or banks that are essentially financing them, they all need liquidity. They start selling off stuff on their balance sheets. Other banks start selling off stuff on their balance sheets. Then you start ahead of a full-on, settlement mentality that can destroy the market really quickly. This is not a good signal. All of these signals right here, these are all signals that the economy is definitely slipping into territory we do not like. Okay, right? GDP growth negative, not good. The market decline, not good. The Fed not coming to the rescue. Inflation not going down, right? Auto manufacturing is decreasing, although slightly. Consumer sentiment not happy. People don't like where their earnings are, and they're starting to become more delinquent on their debt. All of these things are negative signs. There are a couple positive signs, though. That's the +2. So unemployment is still hanging strong. Last year, we bumped above 4% for the first time in 27 months. We actually tied a record from the late 60s, early 70s, I believe, where of 27 consecutive months of below 4% unemployment. That's great. And we have not seen unemployment start ticking up in a significant way. So we're not seeing unemployment, having this sharp increase. 2020 is a very unique case, but typically when we go into an economic recession, we'll see, like right now, if we were starting to go into economic recession, we would see unemployment go from 4.2 to 4.7 to 5.2 to 5.8 to 6.1 to 7.2 to 9%. Like really quickly. It wouldn't just spike from 4 to 15, which is what we saw during COVID when half the population was fired. But it's going to start to tick up, right? That's what we typically see. We haven't seen that yet. And as long as the employment situation is strong, caveat, then the economy is doing well. Side note, there were 20,000 people that UPS has announced are going to lose their jobs. They announced this on Tuesday. That's going to add to unemployment. All of the people who've been fired from the CDC, all the other government employees who've been fired or let go through Doge or Dodge or whatever it's called, they are also going to end up on the unemployment rolls. So we're going to get unemployment numbers next Thursday, next Friday. ADP sends their numbers out, and then we'll see the U.S. Census Bureau labor statistics numbers come out, I think, next Friday. If those numbers go to 4.4% or 4.5%, or, oh my gosh, let's knock on wood and hope not something like 5%, then I think we're still going to be okay. Like if it's 4.2 again or 4.3, I'm like, okay, maybe we survived this. If we start seeing 4.8, 5.2, then I would say, yeah, this signal is no longer a plus signal. And the other signal here is these tariffs, right? I mean, a lot of this, you could argue that the stock market, the consumer sentiment, perhaps unemployment, profitability, a lot of this discontent is driven by the tariff policies and how impactful they're likely to be. But Trump declaring the policies on April 2nd and then putting a 90-day pause, this has historically been something that the president has done over and over again, which is to make some policies and then put pauses on them and try to change them and whatever else. In business, we call this alpha beta testing. It can work out well. Like as a venture capitalist, you destroy things to learn how they work. Which can be really good if you're a venture capitalist in Silicon Valley. But for a president trying to lead the economy, it's not a great strategy, I don't think. People aren't responding well to it. But Trump can still turn around tomorrow and initiate a different policy, which could reverse all of this. Just declare that he got what he wanted from the tariffs. Everybody's coming to the table. They might be. He got the deals that he wants. He's getting everybody to agree to have more free trade. And so then boom, like then he just says, okay, tariffs gone. And the economy goes, okay, that was stressful, but we're fine. I think that's a real possibility. We've already seen some of that. So where are we? GDP growth negative. This is not good. Inflation is not coming down. Tariffs are definitely freaking people out. The market spoke. Consumer sentiment is down. The Fed is holding tight. Well, Trump might pull back on these tariff policies. I think he's going to. Unemployment is still holding strong. So it's a mixed bag. I think some of my colleagues at Goldman and some other places have said, maybe there's a 60% chance. Maybe now there's a 50% chance. So here's my prediction. It's a big if Trump declares victory on tariffs and sort of like changes all those policies again, we can avoid slipping into an economic recession. I mean, and that's a real possibility. If he doesn't, and we see unemployment start to tick up this next month, or maybe even the month after, I think the consumer sentiment is going to fall. People are going to stop spending money. Businesses are going to start not hiring or firing people. And then we'll be in a full-blown recession by October. And so I'm not really putting a percentage on it, 60, 50, whatever else. They're really reliant on a couple of key policymakers, what their policies are, and if they can share those policies with the public and convince them that those policies work, then we could very well be just fine. All right, questions?
We've got lots of questions here.
Uh-oh.
I've been collecting them along the way.
Okay.
So let's start with the first one that we got from Benjamin. One of the main drivers for the tariffs was to increase investment in the US by companies who would have otherwise offshored or outsourced the work, especially manufacturing. Are there any historic examples that would speak to how long or how successful this type of investment would take to spur GDP or other economic growth KPIs?
Actually, there's lots of examples, and it would take years. So think about the Rivian plant that's going up in Georgia. I mean, they've only been building this and talking about it for 4 years. I've worked with some other countries that would like to invest in the Southeast, invest in Georgia, or build a facility here. So if you're going to actually build a facility, you have to think about, you've got to talk to the principals, like a governor, mayors, state senators, what have you. You've got to go through zoning. You've got to make sure that you can maybe get some tax benefits. And then you start planning. So if you want to start capitalizing, like build a facility here, you're planning a year out before you're actually like putting boots on the ground and you're actually putting a shovel in there. I mean, figuratively, right? So even if we started onshoring some of this stuff, it could take 2 years, 3 years before we actually see any kind of manufacturing. But here's the other part of it, is that we say, okay, what we want to do is we want to create people buying things domestically. I mean, I just went fishing with my neighbor, my little next door neighbor who sells plastic resin. And he said, look, this is challenging. Some of these polymers, some of this stuff it's not even made here. Like you literally cannot buy the polymers, the chemicals, whatever it is. There's nobody who manufactures this in the United States. And so if we have to pay these tariffs, we're going to have to increase prices. Okay, why don't you go to some domestic company? There is no domestic company who's making this. Okay, well then let's just invent a company that's going to make it. No, like the company's got to now find a facility. It's going to take years and years. I don't know. The question is there evidence that this can be done overnight? Not in the magnitude that the administration thinks, right? They're talking about rebuilding manufacturing. that could take years to do. I wish I could find some really good examples like, oh, this company just set up a
Well, we've
manufacturing
got
plant.
lots of questions, so let's
Okay.
move on to the next one and see if we can have a
Yeah.
rosier outlook. Lauren asks, so interest rates being lower at the beginning of the pandemic was a time the Fed wanted people to invest. Seems
Yes.
like society should have been doing the opposite during challenging times. What's your view of that?
No. So I understand the sort of juxtaposition there. So here's what happens. The Fed lowers these federal fund target rates. They push more money into the banking system. Banks have more money. Banks will lower their corresponding rates to make it easier for people to borrow money. So, okay, so when the economy is facing a challenge, if banks can make money available to you at a much cheaper rate, then this might encourage you to go out and start a new business. Well, because now that's what gets the economics churning. You might say, so don't people need to save their money when things are becoming challenging? So, as an economist, we don't want people to save their money when the economy is becoming challenging. We want people to spend money in the economy, create economic churn, so companies are forced to fulfill those needs for goods and services. They have to hire a bunch of people to do that, which now creates income, which then creates additional spending and gets the economy going. So as an economist, we don't want people to save during pandemic, during an economic recession. We want people to spend money to get the economy moving. That's a selfish perspective from economists because we don't like recessions. So if everybody's holding on to their money and hoarding, now you find yourselves in these long periods of lulls. It's what we find in Japan. Japan has had lost decades, 10 years, 12 years of economic recession because nobody spends money. And then everybody just loses their job. Like, how do we get everything going? Stop saving.
It's the reason we all tried to support restaurants and our local businesses during COVID.
See, I should have just said that. Yeah, like we want you to go out and spend money at local businesses. Small businesses don't want you to say, don't, they're like, no, wait. Yeah, no, I think you need a thing. Like, I think you need this new blouse. No, I don't. I'm saving my money. No, that blouse would look good on you.
Daniel asks, can you share what impacts you're seeing on the US services exports, so finance and education?
This is one of our best. Well, we've got a bunch of exports, right? One of our exports is tourism. So you got to think about it in terms of the numbers. So if we have, say, Chicago or New York or Los Angeles, even Atlanta, right? Atlanta would say, "Oh, come to Atlanta, go to the Coca-Cola Museum, go to the aquarium, go to the College Football Hall of Fame, right? Go see MLK sites and what have you." Okay, Atlanta is exporting tourism. So you come from another country, England, you come to Atlanta for fortnight. Okay, that would be a long time to spend in Atlanta. All right. And then what happens is you leave all your money here and then you go home. It's as if I've just exported service to you. You've sent me money and I've sent you something. What am I sending you? Tourism opportunities, great Coca-Cola Museum. This is a great opportunity for us. I mean, tourism is a huge part of our economy. Our current immigration policies are keeping tourists away. I don't know. I've read this maybe on a half a dozen articles about how tourism from Canadians is falling, tourism from Europeans is falling, tourism from Australians are falling. People are banding together and saying, we don't really like your vibe right now. Look, we can go someplace else, right? We can go visit some Olympic sites in London for all that. So that's a huge opportunity that we're missing. Additionally, with respect to like student visas and whatever else, yeah, I mean, we are amazing at education, at Emory especially, and we export this product. This has got to be something that we can continue to do, like educate the world. What a great mission that is. But if you are sending a signal that we don't want people from other countries in our country, that will keep people away. And they're afraid to come in, or they're afraid to even leave because they might not get back. Well, then they're going to hedge their bets and say, no, thank you, I'll go someplace else. So yeah, that's a challenge. The current policies are making that more difficult.
Mm-hmm. Yes, I'm hearing it even from my family. I've got a nephew and his wife traveling, and my sister said, "Are they going to let them in?" I was like, "They're two doctors. They've got."
Right?
I think
Yes.
they're
So
going to be
yeah.
fine.
So my buddy just went, and his wife was working the London Marathon, which was this last weekend. And his sister and their family would ordinarily then come to the States during the summer. And they said, no, like, we don't want to get hung up. We don't want to, like, all of a sudden be walking around and have somebody say, what, you're here illegally, and like go through all that jazz. Like, we're just going to wait. Okay. I'm like, okay. The likelihood of that happening is zero. But if they're thinking that that might
Right.
happen, that's enough to prevent them from actually spending money here. That's the other challenge of this, is that when you have policies that are not completely formulated, maybe they're formulated, but maybe they aren't like being described to people in specific ways, then individuals make up their own version of what the policy is. And to them, they say, like, oh, I'm from England, I'm going to get deported. Like, you're a tourist visa, like, you're not going to, okay. And then you just don't spend money. And then that's money that we're missing out in Chicago or Atlanta or New York. We need
Mm-hmm.
that money. Money helps
Yeah,
our economy.
exactly. So on to the next question. Sean asks, to what extent does the end of the student loan deferment drive the increase in the delinquencies that you had? I think, was it number 6 or number 7 slide?
Yeah, that's a great question. Um, Unfortunately, the numbers don't always break out the delinquency by type. I can do a little bit more deep digging, actually, if you guys invite me back to talk some more. I'll do some more deep digging and figuring out if I can figure out like what percentage of what loans are being defaulted on. Um, and I know you can separate it by car loans and all other loans, and then some credit card loans versus all other loans.
Mhm.
So it's very, very possible that student loan delinquencies are definitely ticking up and could add to that. But that's not like it's just your student loan. So here's what the Department of Education said. They're going to start initiating wage garnishments. Well, wait a minute. So if you're defaulting on your loan and they start initiating wage garnishments, that's a bunch of money that's coming out of your paycheck that's not going
Right.
to go to other things. But then that might actually lead to more loan defaults, or it could lead to lower spending, which could lead to, I mean, consumer spending is 70% of GDP. So that could lead to a decrease itself. This is, of course, we don't want people to default on their loans. And of course, we don't want people to default on their education loans. But I mean, there's a cascade of events that could happen that could lead us into a much worse situation.
Yeah, so we've got this. Ken asked another question on that delinquency chart. He said that delinquency started going up from October 2021. His eyesight
Yeah.
must be very good. Most of your indicators or parameters from those charts indicate that all those have started from late 21. Does that mean that the seeds were already sowed back then, and now we are
Yeah.
sort of waiting for the fruits?
Yeah, that's a great observation. So I I've been talking on this, in this forum and in other forums for a long time. And so even though technically the economic recession from COVID lasted 2 months, I believe that there is fallout from COVID that we're still feeling. Everybody thinks, COVID's way in the past. Okay, so technically it's March, right? And we had vaccines, and we're certainly taking a lot fewer precautions these days than we were 2 years ago. But I think the great resignation and quiet quitting, I think that was a fallout from COVID. People are recalibrating how they're thinking about their job. I think labor force participation, we still have, you know, 6 million people, maybe upwards of 7 million people who were in the labor market who are not participating. And that's not all just people who are on the cusp of retiring and retiring. These are 30-something-year-olds, 20-something-year-olds who've just never re-entered the labor market. Where are they? What are they doing? Right. And so, yeah, I believe that this observation is correct. I believe that all of these things are seeds of just how disruptive COVID was. So disruptive, we put lots of band-aids on it by sending out a ton of fiscal stimulus. Here's a check, here's a check, here's a check, here's some PP loans. And everybody's like, oh, my business is strong. Is it at its core really strong? Are you still having challenging finding employees who will do the job? I don't know if people are willing to put their hands up or would like say like, yeah, this has happened to me. I bet there are 10 people who've got 188 people. I bet there's 10 people right here who've tried to hire somebody and they're going through applications and they say, my application clearly says you need a CPA degree and your resume says you're a dog groomer. What the heck are you doing? Or you hire somebody and they say, oh, that would be great, but I'm just not in the mood. I really want to work from home. Oh, okay, you got to come into the office. Well, I was thinking I could just work from home like 5 days a week. No, you got to be here 3 days. Yeah, that's just not really going to work for me. You're like, what? Like, I want you to work, like do the job. Yeah, I don't think so. Like the working thing isn't really working for me, right? Okay, every single
Single hiring
Elizabeth.
cycle, says Elizabeth.
I'm sorry, Elizabeth. Right? That's the fallout from COVID right
Right.
there. Elizabeth, I am so sorry about that. So yeah, every single second of my life.
So Henry
Uh,
asks a question that's related to this, which is there a metric that tracks actual unemployment instead of the unemployed portion of those actively looking?
So there's a couple different metrics that the BLS uses. They have this unemployment, and then they have what they call like fringe unemployment. So people who are marginally employed. So here's the trick. I wrote about this. Years and years and years ago when Ben Carson was running for president. And he was like, you just throw any number in there. And it's like, no, actually, Ben, the way they've been capturing unemployment, that is this rate, has been the same calculation has been going on for the last 80 years. And so there are ways that you can capture marginally employed. And they ask questions about, are you employed in the sector where you've been trained, or are you employed in the sector where you've had your most work? But if people are not looking for jobs and aren't participating, they're not, this person accurately identified, they're not even in the labor force. So like what's the true level of unemployment? It's tough to ferret that out, even if that is a thing, because some people who are truly unemployed don't really want to be unemployed because they're not. So like my mother-in-law lives in my basement. She's retired. She's having 80th birthday coming up. Happy birthday to her. And she's been unemployed. She's been retired since 70. She retired. She quit her job, moved from California over to Georgia. She watches dogs, right? She's a dog sitter. And so does she have like a kind of a little gig economy thing? Yeah, but if you asked her, are you unemployed? She'd say, no, I'm retired. All right. So, but then there's some 25-year-old who says, you employed? They'd be like, no, like I'm a day trader. Like, okay. You want to count the 25-year-old who isn't participating, but you don't want to count the 80-year-old who just watches dogs every once in a while. The questions that would get to that would be so complex, it's almost impossible to do. So I guess the long answer is not exactly. That's the short answer. The long answer was all that other jazz I just said.
Okay. Someone who doesn't want to put their name says, as per the chart, we've already answered that question. That was the same one that was in the chat. Let me ask another question. Bob asked, could you clarify why the Navarro tariff formula was structured to include only goods and excluded services?
So the the formula. Oh, yeah. Okay. I mean, it's actually a really good question. Okay. So this formula that a lot of people have seen here is it's actually it's pretty interesting little formula. So what it does is you've got imports minus exports or exports minus imports. So whoops, hold on 1 second here. Let me do this. Like people are like here. So you have the exports minus the imports from a particular country. So that's our trade imbalance right here, times the price elasticity of demand right there. This is how much of the tariff is passed through to customers. And then this is our imports from country I. That's the formula that they use to actually calculate these reciprocal tariffs. Okay. So they literally took the trade imbalance right here. They made this equal to 4. They made this equal to 1/4 so that these two guys cancel out. And then this is basically our percentage of trade imbalance. And then they multiplied this by 1/2 to get the reciprocal tariff that they were charging. Okay, this is random. Like there's no reason why you just make it a half. And all this formula does here is that this just measures the what our trade imbalance is. Okay. And so this formula, according to the guy who published the academic paper, this formula shouldn't actually even be used to calculate a reciprocal tariff. This formula would be used to calculate the tariff in order to minimize your trade imbalance. Like if you wanted to minimize this thing, okay, then you could impose a tariff in order to minimize that difference right there. But this number he says is actually closer to 1.95. And the elasticity of demand for different products, it changes based on every single product. So just having a 4 and a 1/4 there is completely inappropriate. Like it's just not the way that you should be using this formula. So I know the question wasn't about the formula per se, it was about like what's included and what isn't included in the formula. Here's what's so challenging. They they shouldn't set the values to what they did. They shouldn't just multiply it by 1/2. And then they're tracking not a complete set of the goods and services. Like the trade imbalance is only set on goods. Okay, none of that makes sense from a thoughtful, pragmatic perspective. But also, tariffs aren't necessarily put in place to undo a trade imbalance, right? So like here, I mean, I'm drinking a cup of coffee. So according to this equation, the administration would say, "Oh, we should put a tariff on coffee to minimize our trade imbalance of coffee." Well, wait a minute. Our trade imbalance in coffee is always going to be negative because the United States isn't in the coffee zone. We don't grow coffee here. We will always have a trade imbalance of coffee. Guess what? Make a tariff of 0 so everybody can enjoy a really nice Costa Rican blend and then be done with it. Like, why even? You shouldn't even be paying attention to this. Or chocolate. Okay, we don't grow cocoa beans here. So we're always going to have a trade imbalance of chocolate. Polymers that are used to make contact lenses. We don't make that stuff in the United States. Why would we want to disrupt the trade imbalance of cocoa beans and coffee? And we don't. We are never going to onshore coffee production in the United States. Will never happen. Okay, why are you having this huge tariff in Costa Rica? Makes no sense, right? What are their biggest exports? Probably cotton t-shirts, coffee, and bananas. Okay, I mean, the two of these three things we're never going to grow here. So, I mean, who cares about that trade imbalance? What you want to do is you want to ship things to them. Oh, I mean, it's very frustrating because I think there could be some good tariff policies, but not in a haphazard way. You have to have thoughtful people who are engaging in thoughtful policies. What's your objective function? It makes you very frustrated. You're like, no, we can't tell it all there, Tom.
All right, off that soapbox, Tom. We've got a couple of other questions that sort of relate to one another. So let me just ask the one that Purvi asks. On one hand, reports say employers are laying off people. Other reports say baby boomers are retiring and we do not have enough workforce. How do those two align? And then I'm going to Court also add something about baby boomers pulling out of investments, finances to put theirs into cash, treasury bonds, CDs, very conservative. So they're not infusing cash into sort of a system that would be focused on more aggressive investments. I think that's what he's saying. Any thoughts?
I mean, it's a combination of, I mean, some really great observations and really great questions. So here's a couple trends with respect to baby boomers. Absolutely. If as you get older, right, you should be moving your investments from equities to fixed income. So treasuries, tax-free municipal bonds, you're going to be buying structured products that have very, very conservative upside, but almost no downside risk. So that's what it doesn't matter what generation you call it. Older individuals who have money invested are going to be doing that anyway. Much older individuals actually all worked for GE for 30 years, had a benefits package that was a defined benefit, so they just got like 70% of their income forever, right? Like my grandparents, right? So like worked for GE for 1,000 years, and when he retired, literally got a gold watch and just got a pension until the day he passed. I mean, that just doesn't happen anymore. Baby boomers are pulling their money out, and so are people who are not quite in that generation who are getting older of risky investments. But that doesn't not put money into the economy. They're just buying different types of assets. So tax-free municipal bonds or treasury securities are investments. They're just different types of investments that carry different risks. Did COVID create a bunch of, let's say, retirements? I think it did. And those people definitely moved out of the labor market. But when we're looking at labor force participation, we would typically see a roll off of participation as people hit, late 60s, early 70s. And we saw a little bit of that sort of predating where they would have been if COVID hadn't hit. But we saw a very typical pattern. But also with COVID, we saw 30-year-olds and 40-year-olds and 20-year-olds just disengage from the labor market in numbers that we hadn't seen before. And those people still haven't come back to the labor market. What are they doing? Where are these people, right? Where are they making their money? That's what economists are still scratching their heads about. And so we can disconnect those two ideas. The other thing I think which is challenging with respect to baby boomers is that given the current mortgage rates being quite high, the boomers historically are older individuals as they empty nest, start selling their home, buying townhomes or condos with less upkeep, and putting these homes on the market, which increases the supply, ceteris paribus, which keeps home prices down. The current baby boomer generation are not selling their homes. So you're not seeing this influx of supply for single family properties, mostly because they say, okay, what am I going to do? They get a mortgage at 7%. I just paid off a mortgage at 2%. I'm not going to jump into one at 7.2% or 6 7/8. I'm just not going to do it. And they say, like my house, screw it. I'm not going to mess with it. Wow. Like that's a huge decrease in supply, which is keeping prices up. I think that's an issue that's going to continue to persist. So we're going to continue to see high home prices.
Well, this is fascinating. Tom, I really want to thank you for your insights and the 7+2. Let's hope that doesn't end up in recession, that the 2 outweigh the 7.
Yeah,
We
hope so.
appreciate it. Over to the team.
Thank you, Tom. That was a very informative session. We are going to be looking out for the unemployment news late next week and trying to put everything together that you have shared with us today. So thank you very much. Looking ahead at our next Business Over Breakfast on May 15th, we will have Professor Ryan Hamilton cover the difficulty in targeting multiple customer segments. He will be sharing tips from his upcoming book, The Growth Dilemma, on how to do this more successfully. Also ahead, in executive education, we have some courses coming up on May 13th and 14th on disrupting your business strategy. We also have executive coaching program coming up, virtual, starting this July. Seats are limited, so please look into it at the email below if you're interested in enrolling. And we also have an in-person session this October. We also have online asynchronous short courses and certificates this summer on digital transformation, analytics, and AI. There's a link below if you're interested and could enroll right away. Thank you for joining us today.